unmuted. And maybe, I suppose you can see my screen. I'll put on my video. So I hope I can squeeze into the 10 minutes. Let's see how I go. But you can see from the outline that it may be difficult. So I've got about 6 slides, which are 6 points. The first is just how do we understand debt almost sociologically more than economically. The second is then there's 2 issues really that I think are important. One is understanding our position in some kind of global hierarchy. And secondly, understanding our almost unique position as South Africa in respect of domestic assets. I'll then very quickly just motivate why, in my view, the debt crisis is chronic. And there's 2 reasons for that. The first is that the deficit is entrenched. And the second is that the interest rate is higher than the growth rate, and that also appears to be entrenched. And then I'll show you a couple of indicators of why I think debt is a problem for fiscal policy, and look at the fiscal policy implications. So the state has 2 primary means of extracting surplus or resources from society. The first is through taxation, which involves a compulsory extraction of resources from the private sector. The second is debt issuance, which in the normal course of things is a voluntary transaction on a market. Of course, I could have added money, but that's a debate for another day. Maybe we'll come back to it later, but it's there, but I don't want to go into it now. So the ability of a state to issue safe assets to private creditors at low interest rates over the long term is an important aspect of state development and an important aspect of economic development. And it is a capacity that I think we will all agree should not be placed at risk, because it's important for the state to be able to deliver its functions. And South Africa is, again, in an almost unique position in relation to this capacity in the developing world. So what is sovereign debt? It's a property right encoded in law that entitles the bearer to a share of national income, which the state guarantees that it will extract from production using its power of compulsion for a long term, for very long into the future. And therefore, if that's how we understand debt, we should also understand that judgments about debt sustainability are always contingent, and they are judgments, and reasonable people can have disagreements about whether a particular state is in a sustainable debt position. Because what you are doing when you do debt sustainability analysis is basically asking whether the state is able and or willing to extract this rent out of production in periods that stretch long into the future. So, and that depends on the one hand on the economic capacity of the state, of the society. Is it growing, or what's happening there? Is it creating economic value which can be extracted to pay this rent? And also on the political economy of that rent extraction. Do we want to pay this rent? And are we likely to balk at paying this rent? So both of those things rest on partly on moral and ideological judgments about the future. So debt sustainability analysis is always going to be subject of debate. Also, debt involves power relations between the state, private capital, taxpayers, and the beneficiaries of public spending. And in many senses, debt crisis you can think of as about distributional issues. Is the state prepared to redistribute resources, either from the beneficiaries of public spending, or from taxpayers, or from some other source, in order to service the holders of private capital and their rent needs? And of course, in that relationship, there are asymmetries dependent on bargaining power, institutional power, voice and exit. So for emerging markets in general, I think it's very important. One of the things we tend to miss a lot in the current debate about debt, there's almost like a view that because Biden is doing it, we can also do it. And certainly the reconsideration of fiscal policy in the global north is very important to open new possibilities for ourselves. But the conditions we face here are very different. And it's important for us to understand that. So there are international and domestic aspects of these power relations that we need to take into account. So first, on the international aspects, we should understand that we're issuing debt into a global monetary hierarchy. And we can reflect on this in many different ways. And we can discuss it, many different aspects of this hierarchy. I mean, developing countries lack full economic sovereignty. Why? Because they continue to have colonial production structures. Welcome, Duma. Just go on mute. Which means they are vulnerable to terms of trade shocks and balance of payments constraints. More recently, there's a literature about how we are inserted into global value chains, and power is exercised through these global value chains to extract rent at different points in these chains. And this really has consequences for GDP and GDP growth. But lastly, and perhaps the one we've thought about least in South Africa, but I think some of our international guests are certainly leading theorists of this type of issue, is currency hierarchies and the idea of a global monetary system of which we are part. Now, I'm just illustrating one aspect of this hierarchy in this graph, which shows, I mean, often we're told South Africa's debt is low. It's only about 80% or 60 or 70 or 80% of GDP. It doesn't really matter, but it's low compared to many other countries. Therefore, we can issue more debt. And so one of the things I'm illustrating here is that misses the point. Because if you come, so on the vertical axis, I've got debt of general government as a share of GDP. By the way, this is the IMF's projection for 2024. So I'm trying to look forward to say, after coronavirus and has passed and everything, what is the current kind of mainstream assessment of where we're going to be? So the United Kingdom is going to be sitting on about 80% debt to GDP ratio, which is similar to South Africa's debt to GDP ratio, which is also around 80%. The big difference between us and the United Kingdom is the debt service costs. How much is the rent on debt that we have to draw out of national production and pay over to financial institutions, foreigners, and relatively affluent South Africans, in fact, extremely affluent South Africans. And in the United Kingdom's case, it's about 1% of GDP. In South Africa's case, it's about 5% of GDP. And this is not an accident, as these two regression lines show, with the blue showing the advanced economies and the orange showing emerging markets. Consistently, emerging markets pay much higher rent on their debt than developed countries. And this is the problem for us. So even a Greece, which has a debt to GDP ratio, or is estimated to be around 150% of GDP, is paying less as a share of national income, rent on that debt, than South Africa is paying. And this is consistent across all emerging markets. So our condition involves generates these financial counterparts: high profit, low investment equilibrium. Sovereign liabilities of South Africa are not necessarily safe relative to the global safe asset, which is a dollar bond. We have high interest rates and high interest payments on our public debt, high levels of rent extraction. Our monetary and fiscal policies are vulnerable to policy shifts in the core economies, and debt sustainability in emerging markets going back for hundreds of years has been a story of emerging markets that think they are sustainable in benign global monetary conditions. And then some shift in monetary conditions at the core, in the core economies, leads to a sudden insolvency of emerging markets. This goes back for a long time, and we remain vulnerable to such shifts. And so the point I'm making, I suppose, is that right now we have very benign global financing conditions. But for us to assume that those conditions will remain like this into the future is a risky assumption, even if we can debate whether it will. So, but now in the previous slide, I've kind of been saying South Africa is a typical emerging market and is in line in terms of that regression line, very much with the other emerging markets. But there's something very unique about South Africa. And it's reflected in this graph, which shows pension fund assets as a share of GDP. And you can see that in South Africa's case, it's about 100% of GDP in pension fund assets. And no other emerging market is at that level. It's not necessarily a good thing or a bad thing, but it does change the conditions into the conditions of the domestic debt market fundamentally. So 90%, and because of this, these assets are pension funds, insurance, and also bank assets, extremely large compared to any other developing country. So 90% of our sovereign debt or thereabouts is Rand denominated. About 40% of that is held by foreigners. Now, because we have open capital markets, those foreigners can easily dump that debt, but domestic asset holders cannot, or domestic residents holding Rand assets cannot shift those assets into other currencies beyond a limit of 30%. So while we do have, in my view, overly liberalized capital markets, there is one of these, there is one regulation which is not liberal at all, which traps capital, Rand-held capital in the South African market. And this conditions us or cushions us from liquidity crises and sudden stops of capital, because when we have a large capital outflow, that leads to a depreciation in the value of the domestic assets, an increase in the return on those assets. And as a consequence, these domestic asset holders benefit because they get a higher return and shift into the holding of domestic assets. It also, this fact creates potential policy space for us. So compared to other emerging markets, you would think we have much more monetary sovereignty, to use the MMT's favorite term. And so the capacity, because these assets are trapped in South Africa, we have a capacity for compulsory financing or financial repression, as others like to call it, that others don't, which is also a material factor in thinking about our debt. But it's important to remember that, 100% of GDP in South Africa, great. It compares to 100% of GDP in the USA. But the South Africa's GDP is about equal to the USA's defense budget. So while these assets are huge in relation to South Africa's GDP, in global dollar markets, it is minuscule. And small shifts in portfolios can have massive effects on the value of our domestic Rand assets. Also important is that the value of these assets depends on future returns, which is ultimately about the prospects of South Africa's economy to grow and develop. And if those prospects are in doubt, the value of these assets will also be in doubt. If the return on capital is in doubt, because people suspect we're going to be going down a path of compulsory financing, for instance, then the value of these assets will also be in doubt. So we do have unique features, but that does not liberate us from the structural realities of the global financial economy. So I think so. So I like to say that our debt crisis is not acute; it is chronic. And I'm using a medical metaphor. So acute is when you have to go to the hospital. Chronic is when you're on medication for the rest of your life. And so it's not an emergency, but it's a problem. It's a lifestyle problem. And so that for several reasons, I don't think that we are likely to face a liquidity crisis on South Africa's public debt because of this large rand asset base, because of the capability of the Reserve Bank to intervene, and because the state itself has significant resources on its balance sheet. It means that it is possible for us to consume our financial assets instead of facing a liquidity crisis. So it's a chronic crisis. And what are the elements? But chronic is also a problem because it's entrenched and embedded. And our debt to GDP ratio has been rising and rising and shows no sign of stabilization. And I don't expect it to stabilize. As I said earlier, debt sustainability analysis is always contingent. But on the one hand, the deficit, so there's kind of three elements in a classic debt sustainability analysis. It's the primary balance, which is shown here in blue. It's the interest rate and the growth rate. So the primary balance, I think Joe was asking me before, and I'm guessing here the blue bars, it's around 1% of GDP. But the point is that increasingly the deficit is dominated by debt service costs. The primary balance is likely to close. This deficit is likely to be revised, to be improved in a few weeks because we do have these elevated commodity prices and for other factors. But in general, the message here for me is that we've had an entrenched structural budget deficit for the last decade. This is not a response to coronavirus. And even once we withdraw the response to coronavirus in terms of treasury estimation, we're going to be left with the biggest deficit we've had for 10 years before we even begin thinking about stimulus measures or something like that. This is just normal. On the right-hand side, you've got the real bond yield. And you can see here over the last decade, we've had a rising bond yield, which is now around, this is real, so it's 6 or 7%. In nominal terms, it's 9 or 10%. And we've had falling real growth rates. And a lot of this depends on, I suppose, what you think the path of debt is. I think what's important about this for me is that we can think about heterodox approaches to debt solutions, which I'm going to come back to. Compulsory financing, inflationary financing, however we might think about it. But there's, on the one hand, if you look at Asia and growth, you have rapid accelerated economic growth in which the state intervenes to hold down interest rates, thereby keeping the interest rate below the growth rate. Here we have rapid and accelerating risk premia and interest rates combined with decelerating growth. And the idea that you're going to somehow bring the interest rate down to below the growth rate in that condition, I don't think is very credible. So the projection here, it might be right, it might be wrong, but after the kind of recovery from coronavirus, we're going to remain in a position where our interest rate on public debt is far above the growth rate. I should say, if you use I've shown here the 10-year bond yield. If you use the effective interest rate on public debt, in other words, the debt service cost, it's a bit lower. But still, by any reasonable projection, the nominal, and whether it's nominal or real, interest rates are higher than growth.
Michael,
so, I've got two more slides.
Nudge you here.
Good.
Yes.
I'm going to finish up. So just to say very quickly that right now in South Africa, in the rest of the world, interest rates are kind of lower than they've ever been. In South Africa, interest rates, at least interest rates on government debt, are higher than they have ever been. And so this graph goes back to 1958 or maybe even earlier, 1958. And it's the real is red, the nominal is the dotted line. and you can see that, you know, our interest rates are higher than they've ever been. That is an indicator of fiscal crisis. Secondly, the green line is the growth rate of core government spending, which is essentially primary spending. But I've taken out some other, like bailouts of state-owned companies. So it's the core government spending on social provision, if you like. The growth rate has been declining and declining, and has declined particularly sharply in the last 10 years. But the growth rate, the real growth rate of debt service costs, is at an unsustainable level. So debt service costs, this rent that you have to pay over on your debt, is the fastest element of the, it's growing faster than anything else, and continues, the rate of that growth continues to accelerate. So my last slide, or I will leave you with some thoughts after this, but my last slide is that, so in the absence of faster economic growth, and of course, I know we're going to come back to, but wouldn't more spending create more growth? I'm just abstracting from that to now and assuming that growth is kind of exogenous, which I think it largely is. In the absence of faster growth, this fact that the debt service costs are rising and rising and rising arithmetically imposes on us one of these answers. Either we can accelerate the issuance of debt, which is kind of go back to step one, or we can impose austerity and reduce public consumption in order to create space to pay the rent on debt, which is kind of what Treasury proposed on February. Or we can raise taxes continuously in order to keep up with this public debt. But that is really crowding out space for other spending that could be financed from that taxes. So it kind of goes, you know, you've distributed the burden differently, but it's still a problem. Or we can begin to engage in compulsory or inflationary financing. All of these are options, but all of them have consequences. And that's the important thing, I think, to understand, that there's not a magic bullet that's going to make it go away. If we go down a compulsory financing route, we will have to seriously discuss capital account regulation. And we will have to, you know, whether you can do this in a democratic situation where capital has voice and options for exit, it's not an easy thing to do. Now, I think one of the things we often confuse is, you know, in South Africa, the problem is not dealing with the legacy of the debt. The problem is stabilizing the debt. It hasn't yet stabilized, and it doesn't look like it's going to stabilize. What if it does stabilize, and the only condition under which I think it will stabilize is faster growth. If it does stabilize, what options do we have? We then have kind of the same as above. You can engage in an extended period of deleveraging, pushing down public consumption or raising taxes in order to pay off the debt. We could impose some kind of capital levy or wealth tax, which, as Keynes said many years ago, is the scientific solution to this problem. We could run down public sector assets on the public sector balance sheet, in particular the GEPF, to offset the debt. Or we could find ourselves in a situation of rapid depreciation in the value of Rand assets that essentially liquidates the debt. So these are kind of the unpleasant menu of options that we are facing, and this is why I think debt is a problem. Lastly, just some concluding quotes from two important books. The one is Dyson's States, Debt and Power, where he says, the relationship between states, debt, and power exposes the ease with which governing elites and publics fall into the illusion of hubris, fall into the grip of illusion, hubris, and complacency, number one. Number two, the obligation on the state to balance social interests and avoid intolerable outcomes for inhabitants proves exceedingly difficult to discharge once sovereign creditworthiness is in serious doubt. So the reason I'm saying this is that, you know, if we don't, you know, I'm not arguing for austerity, but I'm saying the debt is a problem and we're going to have to fix the problem, else it's going to generate further problems which are going to rebound on us. And then Icon Green and others' book that they've just released, which is called In Defense of Public Debt, somewhat cheekily. But they say individual countries are small relative to global financial markets. They are like dinghies on choppy seas. So I'll stop there. Thank you.
Thank you, Michael, for that and for sharing with us the trends, the numbers. You've put some recommendations on the table, and I'm seeing here that Duma is saying that there are so many other options. I'm hoping that as the day goes, we'll discuss some of these more. Neil saying there that we need to unpack, you know, compulsory financing and the range of tools that have been proposed. So certainly a lot to be discussed later in this discussion today, and we'll have the opportunity to do that. I'm now going to introduce